The next topic is accounting treatment of goodwill. In the last class, we have discussed the meaning of goodwill. It is very difficult to define goodwill. Goodwill is nothing but the reputation of the particular business. Okay, the reputation in the sense favorable location, consumer attitude, consumer patronage towards that shop, then good surroundings, good car parking facilities. All those things are pointed out here, okay, taken into consideration. Okay, so while calculating the goodwill, okay, the company or the firm which purchases the business which contains high value of goodwill doesn't need to take extra effort to gain name and fame from the general public, because already the business has earned a good name and so it pays money for that. Goodwill is an intangible asset and not a fictitious one. Okay, it has its own value. Sometimes it is more than that of the tangible assets in the business. Okay, according to accounting standard 10, goodwill should be treated in the books only when some consideration in money or money's worth has been paid for it. Goodwill we have to consider only at the time of money or money's worth has been paid for goodwill. Whenever the business is acquired for a price payable in cash or shares or otherwise, which is in excess of the value of the net assets of the business taken over, the excess should be termed as goodwill. See, whenever the business is acquired, whenever the business is purchased, in consideration of price, okay, price is the consideration of the business which is purchased. Okay, it may be in the form of cash or in the form of shares or fixed assets like land and building, plant and machinery, etc., which is in excess in the value of net assets of the business taken over. Net assets means assets minus liabilities. Okay, see, if the net assets is worth is 10 lakh, the firm pays 15 lakhs. This excess 5 lakhs is paid for the purpose of goodwill. Okay, so the firm pays 5 lakh rupees for goodwill. Okay, this is the meaning of this definition. Okay, the excess money which is paid over the net assets of the business by the firm for purchasing the business is known as goodwill. Okay. Implication of AS 10 for treatment of goodwill on admission of a partner. As per AS 10, only purchased or acquired goodwill through payment by cash or kind can be recorded in books of accounts and shown as an asset in the balance sheet. Self-generated goodwill or the goodwill of the firm valued on a specified date for admission of a new partner or for change in P&L ratio of partners cannot be raised in the books and shown in the balance sheet because no consideration is paid for it. Previously, before this accounting standard rules, the goodwill can be raised in the balance sheet without the payment. Okay, but after the AS 10 implication, the goodwill should not be raised in the books of accounts and shown as an asset in balance sheet. It has to be paid. Okay, if it has to be paid, then only it can be shown as an asset in the balance sheet. If the partner fails to pay money for the goodwill, then the goodwill will not be appeared in the balance sheet. Okay, self-generated goodwill or the goodwill of the firm valued on a specified date for admission of a new partner. For admitting the new partner, so many adjustment the firm has to make. Okay, new profit sharing ratio and then sacrificing ratio and then revaluation of assets and liabilities. Sometimes capital can be adjusted. Okay, so if they value the goodwill, that value should not be raised, should not be appeared in the books unless otherwise the partner is paid for it. Okay, so it should not be shown in the balance sheet because no consideration is paid for it. If new partner doesn't bring cash for goodwill or fails to pay goodwill amount, then it should not be shown as an asset in the balance sheet according to AS 10. Okay, so the rule of AS 10 is only purchased or acquired goodwill through payment by cash or kind can be recorded in books of accounts. Okay, adjustment of goodwill at the time of admission of a partner can be carried out through the partner's capital account directly. Okay, adjustment of goodwill at the time of admission, it has been carried out through the partner's capital account directly. Directly we can make changes in the capital account. The adjustments of the goodwill directly influences the capital account of the partners. Okay, first one, if a new partner brings any premium means the cash paid for goodwill. He has to bring cash for goodwill because the old partners, at the admission of a new partner, the old partners have to sacrifice some of their profit. They have to make some sacrifice, okay, for compensating that sacrifice made by the old partners. The new partner should bring some amount for goodwill. Okay, that amount is called premium. Such premium or goodwill should be distributed among the existing partners in their sacrificing ratio. Okay, that premium can be distributed among the existing partner in their sacrificing ratio. Why? Because he has brought cash for the purpose of compensating the sacrifice which are made by the partners. Sometimes there are two partners, A and B, in a firm. C is admitted as a new partner. A sacrifice the entire amount of his shares. Suppose 10% is sacrifice made by the partners. This whole 10% is sacrificed by A. B's sacrifice is nil. In that case, the amount which is brought by C as in the form of a premium should be transferred to A only, not B, because B doesn't make any sacrifice. Okay, so for the purpose of the compensating the old partner's sacrifice, he brings cash for goodwill. Then second, if goodwill of the firm is valued at the time of admission, it should not be brought into books because it is an inherent goodwill and not purchased goodwill. The value of goodwill evaluated should be adjusted through partner's capital account. At the time of the admission as well as the retirement, the firm has to value the goodwill. Okay, that goodwill is called inherent goodwill and it is not a purchased goodwill, and so that should not be appeared in the balance sheet. Okay, the value of goodwill evaluated should be adjusted through partner's capital account. Third case, if goodwill already appears in balance sheet. If information is given in the problem that goodwill appearing in the balance sheet is purchased or acquired goodwill, no step is necessary. Goodwill is appeared in balance sheet just like any other assets. So if any information is given in the problem that the goodwill appearing in the balance sheet is purchased or acquired goodwill, so that is not an inherent goodwill, that is purchased or acquired goodwill, and so we don't need to pass any entry. Goodwill appeared in balance sheet is just like any other assets, just like the plant and machinery, land and building, furniture, like that. We have to treat goodwill also. If nothing is mentioned, whether goodwill in balance sheet is purchased goodwill or self-generated goodwill, so goodwill is appeared in the balance sheet. Okay, but no information is given whether the goodwill is purchased or inherent goodwill. Okay, inherent or self-generated goodwill. It should be assumed that it is self-generated and was raised and credited to old partners previously. We have to assume that the goodwill is not a self-generated goodwill, and we have to assume that it is purchased goodwill. It is self-generated and it is raised and credited to old partners. Application of accounting standard AS 10. Goodwill amount paid privately by new partner to old partner. Okay, the new partner may pay the amount of goodwill privately to the old partner outside the business. In such case, no journal entry is needed to be passed in the books of account. There are two partners, A and B. C is admitted as a new partner. He brings cash for goodwill. Premium amount is 10,000. Okay, if he pays the amount privately to the old partners, outside the firm, it is not entering into the firm. C is directly paying this amount to A and B. In such case, we don't need to pass any entry, okay, because it is not coming, okay, it is not entering into a partnership firm. Privately, he is paying the amount to the old partners. Second one, goodwill amount paid in cash fully by the new partner. So here he paid the amount cash fully by the new partner. As indicated earlier, if the new partner brings his share of goodwill, the same is to be shared by the old partners in their sacrificing ratio. After, if the old partners may withdraw full or part of the goodwill amount, he brings cash 10,000 rupees. Okay. So that 10,000 rupees should be distributed among the old partners in their sacrificing ratio. If the sacrificing ratio is 1:1, capital account is credited 5,000 rupees, B's capital account is credited 5,000 rupees. Okay. So the amount which is brought for goodwill is for the purpose of compensating the sacrifice which are made by the partners, and so it should be distributed among the old partners according to their according to the proportion of their sacrifice. Okay, so if it is 1:1, then 5,000 and 5,000. Okay, then the old partners may withdraw the full amount or half amount or any amount of the goodwill amount. That is up to them. A may withdraw 2,000 rupees. B may withdraw the entire 5,000 rupees. Or he may withdraw 4,000 rupees. Or B may withdraw 1,000 rupees. That is up to them. Okay. They can withdraw the money. Okay. This is rule number 2. Journal entries. Let's see the journal entries. First journal entry is old partner's capital account debtor to goodwill. If there is any goodwill in the balance sheet or in the book, that should be written off in the old ratio, because that is an inherent goodwill. Okay, it is not a purchased or acquired goodwill, and so it should be written off. The journal entry is old partner's capital account debtor to goodwill account. And the second one, amount brought in by new partner for cash. He brings cash for goodwill. Okay. So for that, if a new partner brings cash for goodwill, then the entry would be cash account debtor to goodwill account. The first entry is written off the goodwill which is in the balance sheet. Second entry is new partner brings cash for goodwill. For that we have passed second entry. Third entry, goodwill account debtor to old partner's capital account. The amount which is brought by the new partner for the purpose of goodwill should be shared between the old partners in their sacrificing ratio. The entry would be goodwill account debtor to old partner's capital account. Then the fourth entry is they may retain the cash, or the old partners may retain the cash, or they withdraw the cash. That is up to them. So for that, the entry is old partners capital account debtor to cash account. Goodwill amount withdrawn by old partners. Sometimes new partner may bring premium in the form of assets. Okay. What is the entry for that? Let's see. For assets brought by new partner, it may be stock, it may be building or debtors, furniture, plant and machinery. Okay. Any assets he can bring. Okay. All the assets which are brought by the new partner should be debited. Stock account debtor, building account debtor, debtors account debtor to new partner's capital account, to goodwill or premium account, being assets brought by new partner for his capital and share of goodwill. Say for example, stock is 10,000 rupees, building is 1 lakh rupees, then debtors is 40,000 rupees. The total assets which is brought by the new partner is 1,50,000. So for capital, he brings 1 lakh rupees and 50,000 he may bring for goodwill purpose. Okay. So the amount which is total amount which is brought by the new partner is 1,50,000. Out of 1,50,000, 1 lakh may be brought for capital, 50,000 may be brought. It may be changed. Okay. 75,000, like that, 25,000, 1,25,000, 25,000. So the amount which is brought for the purpose of capital should be credited to new partner's capital account. The amount which is brought for goodwill should be credited to goodwill or premium account. Then for crediting premium or goodwill to old partners, goodwill or premium account debtor to old partners capital account, being premium for goodwill credited to old partners in their sacrificing ratio. Okay. The amount or kind whatever he brought, that should be distributed among the old partners in their sacrificing ratio. Then the next case is goodwill amount paid partly by the new partner. Sometimes the new partner may not be able to be his entire share, okay, bring his entire share of goodwill of the firm in cash or kind. In such case, whatever amount the new partner brought is to be debited to cash account. The unbrought amount is to be debited to new partner's capital or current account, and old partner's capital or current account, and old partner's capital account ought to be credited with the full amount in their sacrificing ratio. Sometimes he may not be able to bring full cash. Okay. So in such a case, whatever the new partner brought is to be debited to cash account. Then the unbrought amount is debited to new partner's capital or current account, and old partner's capital and current account to be credited with the full amount in their sacrificing ratio. In case goodwill already there in the balance sheet at the time of admission is to be written off in the old ratio by debiting old partner's capital account and crediting the goodwill account. If he fails to bring entire amount, then the amount which is brought by the new partner is debited, and the unbrought amount is debited to the new partner's capital account, and the capital or current account of the old partners is credited with the full amount in their sacrificing ratio. In case if there is any goodwill in the balance sheet, that should be written off in the old ratio by debiting old partner's capital account and crediting goodwill account. This is the treatment if the goodwill amount is paid partly by the new partners. Journal entries for the above case. Old partner's capital account debtor to goodwill. So assuming that the goodwill already in the balance sheet, okay, it is shown in the balance sheet, that amount, that value of goodwill should be written off in the old ratio. Okay, for that the entry is old partner's capital account debtor to goodwill account. Then cash account debtor to goodwill account, part of the amount brought in by new partner for goodwill. So suppose 10,000 rupees is his share of goodwill. He brought only 5,000 rupees. This 5,000 rupees is to be entered here. Okay, cash account debtor to goodwill account is 5,000 rupees. First one, if there is any goodwill in the balance sheet, that should be written off. The entry is old partner's capital account debtor to goodwill. Then the amount which is brought by the new partner, part payment maybe. Okay, in that case, the entry would be cash account debtor. The amount which is brought is debited and credited to goodwill account. The amount which is brought by the new partner for goodwill. Then goodwill account debtor, part cash brought in for goodwill. Say for example, previously as I told 10,000 rupees. Out of the 10,000 he brought 5,000. He failed to brought 5,000 rupees. Okay. So in that case, the amount which is brought by the old partner is 5,000. That is part payment. Okay. Then he failed to bring 5,000 rupees. That should be debited to his capital or current account. It depends on the capital account. Okay, whether they follow fixed capital method or fluctuating capital. Okay, it depends. But his capital account should be debited to the extent of unbrought goodwill. Then to old partner's capital account, shared in sacrificing ratio. Then the entire amount, full amount. The full amount is 10,000. Out of this 10,000, 5,000 he brought. 5,000 he failed to bring. Okay. So the whole 10,000 should be credited to old partners in their sacrificing ratio. This is the journal entry. These are the journal entries we have to pass. If an old partner make part payment for goodwill. No goodwill amount is brought in cash by new partner, but it is valued. Due to financial constraint, the new partner may not be in a position to bring his due share of goodwill in cash. In such a case, the amount not brought for goodwill is to be debited to new partner's capital or current account, and the old partner's capital account ought to be credited in their sacrificing ratio. The due share of new partner's goodwill is to be ascertained by multiplying the new partner's share of profit with the valued goodwill of the firm. If he fails to bring, sometimes due to some financial constraints, okay, crisis, he may not be able to bring his due for goodwill in cash or kind. Okay. So in that case, the amount which is not brought by the new partner for goodwill is debited to the partner's capital or current account, credited to the partner's old partner's capital account in their sacrificing ratio. One thing you should remember clearly, the amount which is brought for goodwill is premium. That premium amount is paid to the old partners to the extent of the sacrifice which is made by them. For sacrifice which are made by the old partners, he brought cash. Okay. Suppose in the above case, if there is any goodwill in the balance sheet, the same is to be written off in the old ratio by debiting old partner's capital account and crediting goodwill account. The entry is old partner's capital account debtor to goodwill. Goodwill written off should be in the old ratio. Then new partner, second entry, he failed to bring cash for goodwill. For that, the entry is new partner's capital or current account debtor to old partner's capital account shared in sacrificing ratio. So new partner capital account should be debited and old partner's capital account should be credited. So this entry is for goodwill amount which is not brought by the new partner, and this one is the amount which is not brought by the new partner should be credited to old partner's capital account in sacrificing ratio. Hidden goodwill. Sometimes the goodwill amount is not directly given. We have to find out the value of goodwill. Okay. So the profit of the current year and previous year are not given. The question is also silent about the method of calculating the goodwill. What are the steps we have to follow to find out the hidden goodwill. First, find the total capital based on combined capital of old and new partners. The total of capital of the firm has to be found out by adding the capital of all the partners in the old firm plus the capital of the new partners. In case many items of assets and liabilities are given, capital of new partner will be the difference between assets and liabilities. I hope you know the basic concept in accountancy. Capital is equal to assets minus liability. Okay. So, first we have to find out the total capital. The total capital means addition of both old partners capital as well as the new partners capital. Step 2. Find the total capital of new firm based on new partners capital. Okay. Based on new partners capital, we have to find out the total capital of the new firm. Previously, what we have calculated? We have calculated the total capital. Here also, we have calculated the total capital. The base is combined capital of old and new partners. We have added the old partners capital as well as new partners. But here on the basis of the new partners capital, we have calculated the total capital of the new firm. Third step, find the amount of goodwill. The excess of total capital of the new firm over the combined capital of old and new partner is to be taken as amount of goodwill. In the absence of any other adjustment, the increase in capital must be due to hidden amount of goodwill. Then we have to find out the combined capital with the new firm capital, total capital of the new firm. Okay. The excess amount, suppose the combined capital of old partners as well as new partner is 1 lakh rupees. Then the total capital on the basis of new partners capital is 1,50,000. The excess amount is 50,000 rupees. This 50,000 rupees is considered as the value of goodwill. In the absence of any other adjustment, the increase, it has been increased from 1 lakh to 1,50,000. The new firm capital is 1,50,000. Previously, it was only 1 lakh. Here also we have added the new partners capital. Here also, but here the basis is new partners capital. So, on the basis of new partners capital, we have calculated the capital, total capital of the new firm. So, we are comparing the previous capital, that is combined capital of old partners as well as new partners, the total capital of the new firm. The excess amount is nothing but goodwill. This is called hidden goodwill because it is not directly given in the problem. A and B are partners sharing profit in the ratio of 3:2. They admit C into partnership. C pays a premium of 2,000 for 1/4 share of profit. No goodwill account appears in the books. They withdraw the amount of goodwill, journalize. There are two partners. They are A and B. They share profit and losses in the ratio of 3:2. Who is admitted as a new partner? C is admitted as a new partner. C pays a premium. Premium means the amount which is brought for goodwill, 2,000 rupees. His share is 1/4. 1/4. 1/4 is a share in the new firm. No goodwill account is appearing in the book, appeared in the book. They withdraw the amount of goodwill. Who withdraw? The old partners withdraw the amount of goodwill, journalize. The entry is cash account data to goodwill account, being the cash brought by C for goodwill, 2,000, 2,000. Then goodwill account data, 2,000 rupees to A's capital account to B's capital account. In the sacrificing ratio, what is their sacrificing ratio? Let's see, the old share is 3:2. They admit C into partnership for 1/4 shares. The sacrifice made by the partners is not given, and so the old ratio becomes the sacrificing ratio. The sacrificing ratio is also 3:2. So here the 3:2, if we distribute the goodwill, the premium among the old partners, then the A's capital account is credited to the extent of 1200, B's capital account credited to the extent of 800 rupees. Then the partners, old partners withdraws the amount. Okay. So the entire amount, we have to assume that the entire amount is withdrawn by the old partners. So A's capital account debtor, B's capital account debtor to cash account. Okay, that is up to them. That is their will and wish. They may retain the cash or they may withdraw the cash. Okay, here they withdraw the entire amount or they may withdraw half of the amount. Okay. So further the entry is A's capital account debtor, B's capital account debtor to cash account. Question number 2. Goodwill in books. X and Y are partners sharing profit in the ratio of 3:2. They admit Z into partnership. Z paying a premium of 4,000 for 1/4 share of profit. The new ratio is 3:3:2. The goodwill account appears in the book at 4,000 rupees. Journalize. There are two partners, X and Y. Their ratio is 3:2. They admit Z. Z brings a premium of 4,000 rupees for 1/4 share. New ratio is given 3:3:2. So old ratio and new ratio is given. First we have to calculate the sacrifice ratio. Then the goodwill account appears in the book. Already in the book there is 4,000 rupees in the 4,000 rupees for goodwill. Okay, journalize. Let's see. Calculation of sacrificing ratio. Old ratio minus new ratio. Okay. Old ratio is more than that of the new ratio because the old partners sacrifice some of their shares for the new partners. So the X old ratio is 3/5, new ratio is 3/8. Y old ratio is 2/5, new ratio is 3/8. So the sacrificing ratio is 9/40 and 1/40. The sacrificing ratio between partners is 9:1. The first step we have to calculate the sacrifice ratio. Then we have to pass journal entry. He brought 4,000 rupees. For that 4,000 rupees for goodwill. So for that the entry is cash account debtor to goodwill account 4,000 rupees. Then the amount which is brought by the new partner should be debited and credited to old partners in their sacrificing ratio. So goodwill account debtor 4,000 rupees to X capital account is 3,600, Y's capital account is 400. So it is distributed among the old partners in their sacrificing ratio. And then the old goodwill account which appears in the balance sheet is 4,000 rupees. So the X capital account debtor, Y's capital account debtor to cash. That is written off. Okay. So that is written off. For that the entry is X capital account debtor to Y capital account debtor to goodwill account. To goodwill account. The entry is they are the goodwill which is in the account is written off, not withdrawn. Okay, the amount is written off because already there is some goodwill in the balance sheet that is written off. Further, the entry is old partners capital account debtor to goodwill. Okay, then next one. Question number 3. P and Q are partners in a firm sharing profit in the ratio of 4:3. On 1st January 2020, they decided to admit R as a partner. R brought rupees 1,20,000 as his capital and 28,000 for 1/3 share of goodwill premium. On R's admission, goodwill appeared in the books of the firm at rupees 42,000. Pass necessary journal entry. P and Q are the old partners. They are sharing profit and losses in the ratio of 4:3. They admit R as a partner. R brings 1,20,000 capital and 28,000 rupees for 1/3 share of goodwill. This is premium which is brought by the R. On R admission, goodwill appeared in the books. Already at the time of admission, there is goodwill in the book that is valued at 42,000 rupees. Let's see how to do. In this problem, sacrificing ratio is equal to old ratio. Since the sacrifice made by the partners are not given. The journal entry is, first we have to return off the goodwill which is in the book. Further, the entry is P's capital account debtor, old partners capital account data to goodwill account in the old profit sharing ratio. Okay, old profit sharing ratio is 4:3. So P is capital account data. The amount of goodwill which is in the balance sheet is 42,000. So P is capital account data 24,000. Q's capital account data 18,000. To goodwill account is 42,000. Then second entry we have to pass the amount which is brought by the capital as well as goodwill. Okay, so the entry is cash account data 1,20,000 or is a new partner or brings 1,20,000 rupees for goodwill and 28,000 rupees for 1,20,000 for capital and 28,000 rupees for goodwill. Further, the entry is cash account data. The total is 1,48,000. R's capital account is 1,20,000. To goodwill account is 28,000. Being cash brought in by R towards capital and goodwill. Then goodwill which is brought by the R should be distributed among the old partners in their sacrificing ratio. Again, the sacrificing ratio is one and the same, 4:3. So goodwill which is brought by R is 28,000. So that should be debited and credited to old partners capital account in their sacrificing ratio. So goodwill account data 28,000. To P is capital account 16,000. To Q's capital account 12,000. Being goodwill paid by R shared between P and Q in their sacrificing ratio. Then goodwill brought in kind. Sometimes the partners may not be able to bring premium or capital in the form of cash. What would be the entry we have to pass in that case? Let's see. A and B are partners sharing profit and losses in the ratio of 3:2. They admit C as a new partner and profit sharing ratio becomes 5:5:3. This is a new ratio and this is the old ratio. C is a new partner. C contributed the following assets towards his capital and for his share of goodwill. C contributed the following assets towards his capital is stock 1 lakh, debtors 1,40,000, land 2,20,000, plant and machinery 1,50,000. On the date of C admission, the goodwill of the firm is valued at 10,40,000. Pass journal entries. He failed to bring cash, but instead of cash, he brought stock, debtors, land, plant and machinery. Okay. The total value of goodwill is 10,40,000. Well, let's see what is the share of goodwill. Share of C's goodwill. First, let us calculate the sacrificing ratio. The formula is old ratio minus new ratio. Old ratio, we have to calculate the sacrificing ratio only for old partners, okay? Because they have made only sacrifice. We should not calculate, students should not calculate sacrificing ratio for new partners. That is a blunder, okay? So, A, old ratio is 3/5, new ratio is 5/13. So, if we take LCM and if we deduct 25 minus 39, 14/65, and B, the old ratio is 2/5, new ratio is 5/14. If we take 65 as LCM, the ratio will be 1/65. So, the sacrificing ratio is 14:1. Then, this is the journal entry. Total value of goodwill is 10,40,000. Out of 10,40,000, C's share of goodwill, his share in the partnership firm is 3/13. If we calculate his share, it comes 2,40,000. Stock he brought 1 lakh, debtors he brought 1,40,000, land is 2,20,000, machinery, plant and machinery is 1,50,000, and total out of total C's capital is 3,70,000 and goodwill is 2,40,000. The total asset value which he brought is 6,10,000. Out of that 6,10,000, 2,40,000 is goodwill. The balance amount is capital. Okay. Then the amount which is brought for goodwill is distributed among the old partners in their sacrificing ratio, and so goodwill account data to A's capital account to B's capital account. The sacrificing ratio is 14:1. So A's capital is 2,24,000. B's capital is 16,000. Question number 5. Hidden goodwill. A, B are partners in a firm with capitals of 18,000 and 16,000. They decide to admit C into a firm with a capital of rupees 15,000. C is given 1/5 share in the future profit and losses. Give journal entries. There are two partners A and B. Their capital is 18,000 and 16,000. They admitted C. He brings capital of rupees 15,000 and his share is 1/5. You are asked to calculate the value of goodwill. The first step, we have to calculate the combined capital of both A, B and C. Okay, both the old partner as well as a new partner. Old partner is 18,000, 16,000 and new partner share is 15,000. The total capital is 40. Combined capital of old partner and new partner is 49,000. Then on the basis of new partner capital, we have to calculate the capital of the new firm. So 1/5 share, for 1/5 share, he brings 15,000 rupees. And so the total capital of the new firm is 75,000. From 49,000, it has been increasing to 75,000. So the difference between the 49 and 75 is nothing but the value of goodwill. Okay, this is hidden goodwill. Okay, first we have to calculate the combined capital of both old as well as new partner. Then on the basis of the new partner's share, we calculate the total capital of a new firm. Then we have to compare the capital of the total capital of the partners as well as the total capital of the new firm. The difference is nothing but goodwill. Entry is cash account data to G's capital account. For capital, he brings 15,000 rupees. Okay, his share of goodwill is 26,000. Okay, so that should be distributed among the old partners in their old ratio. Okay, the hidden goodwill is 26,000. That should be debited and it should be distributed among the old partners in their old ratio. That is equal ratio. A's capital account credited 13,000. B's capital account is credited 13,000 rupees.